Adjusting entries in a nutshell. Why do companies make adjusting entries? Let's pretend you're in my class and I want you to get out a post-it note and write down why do companies make adjusting entries. I'll give you a couple seconds to write it down. And now let's see if what you wrote down agrees with what I have here. Companies make financial statements, make adjusting entries so that their financial statements will be relevant, reliable, comparable, and to help users make better decisions. You see, what we're looking for here is we're looking for information that you can believe, that is truthful, and if you get information that's relevant, reliable, and comparable, then it's more likely to be information that's usable and is truthful, and that the people who use this information, like bankers and stockholders, can trust. It's all about trust. In Chapter 1, we learned about the accounting equation, how this equation should always be in balance. Chapter 2, we hopefully understood the basic principles of debits and credits, and now it's time to do adjusting entries. So, there are some principles that go with the adjusting entry concept, and the first one is the revenue recognition principle, which says that revenue is recognized when it's earned and can be objectively measured. The second principle relating to adjusting entries deals with the matching principle, which says match expenses that were needed to earn revenues in the same period as the revenue. And then finally, equal time periods, which means for consistency and comparability, the time period should be the same. That is, we should compare a month to a month or a year to a year. Okay, adjusting entries, 3 very important points. Number 1, it's all about revenues and expenses, making sure that revenues are properly recognized and that expenses are proper within that same time period. Also, adjusting entries never involve cash. And third, they're used to show the passing of time. Usually it's to show that either revenues are earned or that expenses, that is assets, have become expenses. That's usually what's going on here with adjusting entries. Now there's only 5 types of adjusting entries, so we're going to take a look at all 5 types very briefly, because this is in a nutshell. Oh, by the way, I started a restaurant before I came to teaching, and there's a picture of my restaurant, and this example of these 5 kinds of adjusting entries deals with this restaurant. Accrued revenue, that's the first type of adjusting entry. You earn it now, but you receive it later. You receive the money later. And the word accrued just simply means cash in the future. So let's look at our first situation. Al's Caterer, that's the restaurant we just had, on the previous screen, caters a party on New Year's Eve and bills customer $200, and they paid us in January. So here's how we're going to record that. There's our accounting equation, and we're going to use accounts receivable and earn fees, and we're going to debit accounts receivable, and we're going to credit fees earned, or earn fees. And that's for the $200, and we're going to do this on December 31st at the end of the year, so that we show this revenue being earned in the current year and not when it's paid. That's what's important here. It doesn't matter when it's paid. What matters is when was it earned, and we'll show that then. And there's the journal entry that you would make on a books, and we're going to do it 2 ways. We're going to show you how the T count looks, and also show you how the journal entry looks. And then this is what's really important, is understanding if you don't make this entry, what's going to be wrong with each of these pieces of the accounting equation. For example, what's wrong with assets if you don't make this entry? Well, they're going to be understated. What's wrong with liabilities if you don't make this entry? Well, there's no liability that's involved in this entry, so liabilities would be no effect. Owner's equity. If you don't make this entry, owner's equity is going to be understated, and revenues, that is this fees earned or earned fees, will be understated. And expenses, since expenses were not affected here, there'll be no effect on expenses. And net income, if you understate revenues and your expenses are not affected, then your net income is going to be understated. So that's accrued revenues. Now let's go a little bit further with accrued revenues and see what happens if it's now January into the new year and the customer pays the bill. So what happens? Here's what we did back in December the 31st. We made this adjusting entry, and now it's time for them to pay us. And when they pay us, what's going to happen is we're going to have a new entry into cash. We're going to debit cash for $200, and we're going to credit the accounts receivable account. That wipes off the receivable, and now we showed the revenue back in December, and now the receivable should be zero since they just paid us. So that's accrued revenues. That is, you earn it now and receive it later. Next, accrued expenses. The expenses are recognized now but paid later. So Al's Catering Company or Al's Restaurant owes the IRS for 2013 taxes, and we're going to pay these taxes of $750 sometime in 2014. So at the end of 2013, we're going to make the following adjusting entry. We're going to have taxes payable involved and tax expense, and we're going to credit taxes payable. That'll increase this account by $750, and we're going to debit tax expense to show that we owe this, and this should be on our income statement, and this should be a liability on our balance sheet as of the end of 2013. Now, and here's the journal entry. And then again, it's really important to understand what is going to happen if we don't make this entry to these elements. So assets. What's wrong with assets if we don't make this entry? Well, the answer is nothing with no effect, because this entry only affected a liability and then owner's equity under an expense type of an account. So nothing is going to be wrong with assets if we don't make this entry. What about liabilities? Well, liabilities, if we don't make this entry, will be understated because this liability won't be on the books. Owner's equity. What happens to owner's equity? Well, it will be overstated because we should know that all expenses lower owner's equity, and this is not going to be on the books, so therefore it won't properly lower owner's equity, therefore will overstate owner's equity. Revenues. There's no revenue involved in this adjusting entry, so revenues will be not affected. Expenses will be understated because that expense should be on the books. And if revenues are okay and expenses are understated, that means net income is going to be overstated. Now, let's go a little further with this. Let's go to 2014. 2014, we pay the IRS. So when we pay the IRS, here's what happens. We reduce cash by $750, and we also reduce the liability. And this will be done sometime in 2014. So let's go on to our third type of adjusting entry. We have prepaid expenses. And in prepaid expenses, what we're looking at is we're looking at something that we've paid for, and usually it's in advance, and it's something like rent or insurance or supplies, and we're trying to ask the question, now it's at the end of the year, how much of this rent or insurance or supplies have been used up? So here's our first transaction. On January the 1st, Al's Restaurant pays $2,400 for 2 years rent in advance, and is now 12/31 of the end of the first year. So here's our accounting equation, and let's first of all make this $2,400 payment on January the 1st. So on January the 1st, we make the $2,400 payment, and we do the following. We debit prepaid rent, and we credit cash. Now this prepaid rent is an asset on our books because it has future value. It has really 2 years worth of future value on it because it's going to be rent for 2 years. Now at the end, and this is not the adjusting entry, this is just the regular journal entry to record the $2,400 rent that we paid in advance. Now it's 12/31, and we're going to show how much of this prepaid rent or this asset has been used up as of the first year, end of the first year. And so if you did a little math calculation, you'd say that $2,400 for 2 years rent is going to be basically $100 a month, and so at the end of 12 months we'll have used up half of this, or we have used up $1,200. And so we'll take half of this asset and turn it into an expense. So we'll credit the prepaid rent account for $1,200, and that's how much is left in the account, $1,200, which is going to be for the next year too. Anyway, and we'll also debit rent expense. So the entry in red is the adjusting entry, and we're going to make that at the end, 12/31. Adjusting entries are always made at the end of a period, so that when we put together our financial statements, they're going to be properly stated, and the information is going to be basically correct. Now, there it is in a journal form, and then we're going to show what happens if we don't make this entry to these elements. So if we don't make this entry to reduce this asset down by $1,200 and show that it's being used up and put into an expense, assets will be overstated, and they'll be overstated by $1,200. What's wrong with liabilities? Well, there's no liability involved in this. There's only an asset and an expense, or an owner's equity account. So liabilities will be unaffected. Owner's equity, if we don't put this expense on the books, then owner's equity will be overstated. And I'm hoping you're following along with me with your train of thought here, so that, and if you're not, slow this thing down and stop it and see if you can fill in these things before I answer them. Okay, so then we've got revenues. Well, revenues are not something that's affected in this entry, only asset and an expense, so revenues will be unaffected. And of course, expenses, if you don't make this entry, expenses will be understated. If revenues are okay and expenses are understated, that means net income will be overstated. Now, let's go into year 2 of this same adjusting entry. In year 2, there it was in year 1, we've shown that we adjusted down this asset by the amount that's been used up for the first year, and now it's 6/30 of year 2. And Al makes an adjusting entry to prepaid rent. Now, normally we don't make adjusting entries in the middle of the year, but we usually only make adjusting entries when we're getting ready to put together financial statements. So let's just say, for the heck of it, that we're putting together a financial statement at the end of June for some reason, like for a bank wants to see something for a loan. Well, we would have to, at the end of June, make the following adjusting entry. We'd have to lower this prepaid rent account down another 6 months, or another $600, and shove that, or put that asset into an expense column, which would be over here. So that would be our adjustment if we made a middle of the year adjusting entry for this account. Let's go to the 4th type of adjusting entry, which would be unearned revenues. Well, unearned revenues are situations where we receive money in advance and we haven't done anything to earn it yet, and then as time goes by we earn some of it, and now it's time to show how much of it we've earned. So unearned revenues answer the following question: how much of the cash that you received in advance have you earned? Well, here's our example. On January the 1st of this year, Al's Restaurant was paid $5,000 to provide gasoline to a customer for 2 years. Now, we got the money up front. We haven't done anything yet to earn it. It is now 12/31 of this year, so a whole year has gone by, and we got $5,000 to provide customer to gas for 2 years. So let's record that. There's our accounting equation, and we're going to have cash and unearned revenue involved here, and we're going to take the cash in, $5,000, and we're also going to show this as a liability. And it's a liability at the time we did it on January the 1st because we haven't provided any gasoline yet. So that's what happens. That's the entry of January the 1st. Now, at the end of the year, looks like we have done half of this work, or we've provided gasoline for half of the time period, which is it's 2 years, so we've done it for 1 year. So let's take half of this liability out of this account and move it over to the revenue account called earned revenue, and it'll be shown as a credit for $2,500. That's at the end of year 1. And here's the journal entry. Oh, I've got an entry. I've made an error right here. This should be, and remember this should be $2,500 and $2,500 right here. So just pretend that I had a $2,500 amount here and another one right here. So my error, but I'm not going to go back and redo this video. So here we go. Now let's see what happens if we don't make this entry. If we don't make this entry to shove or to move out the amount we've earned out of here and put it into revenue, then assets. What will be wrong with assets? Well, there's the asset we took in right there, cash, a long time ago on January the 1st. So this entry only involves a liability and a revenue. And so assets will not be affected if we don't make the entry. What's wrong with liabilities? Well, if we don't make this entry, then what's going to happen is our liabilities will still be $5,000, and they should be the difference here, which is $2,500. So liabilities will be overstated. Then owner's equity. If we don't make this entry, then owner's equity will be understated. And if we don't make this entry, this adjusting entry, then revenues will be understated because we'll put the $2,500 in there. And then expenses. Well, this adjusting entry doesn't affect any expenses, so it will have no effect on expenses. And if revenues are understated and expenses are not affected, then net income will be understated. Now, let's go into year 2, this same situation. There's what happened in year 1, and now it's, again, June 30th of year 2, and we need to put together a financial statement, so we need to do an adjusting entry to bring this unearned revenue account forward to the point in time where we're at, which is June 30th, for whatever reason. Financial statement, bank wants to see something, whatever. And so we're going to take the amount that we have earned up through June 30th, which is half a year, which would be half of this $2,500 or $1,250, and take it out of the liability account and move it over to revenue. So that's showing what would happen at the middle of a year. And so now we're ready to do the last adjusting entry, which would be the adjusting entry for depreciation. And in this example, we're going to buy some equipment, and then we're going to do some adjusting for depreciation. So here it is. Here's a definition of depreciation, which is allocating the cost of fixed assets over their useful life. And let's see what our entry looks like. On January the 1st, Al bought a van for $20,000 with a 5-year life and no salvage value. That is, it was not going to be worth anything at the end of 5 years. It is now $1231 at the end of the first year. So we got to figure out how much to depreciate this van if it has a $20,000 value, 5-year life, and no salvage value. So let's do that. First of all, let's put the equipment or the van on the books. So when we pay $20,000 for this van, we're going to reduce cash by $20,000 and increase equipment by $20,000. Now it's at the end of the year, and we're going to we're going to make the calculation for depreciation. So we'll have a cost minus salvage value divided by the life, and this is going to be 20,000 minus 0 because it has 0 salvage value, and that's still going to be $20,000. And I should have a bracket right there. Forgive me for that. Anyway, it's 20,000 minus 0, which is 20,000 divided by 5, which is a $4,000 depreciation that year. And we're going to do this. We're going to show the depreciation. Now, it took me 2 hours to figure this out, how to do this on a PowerPoint, so I expect you to make some kind of applause on this. So this is technically sort of right, but it's not the way the accounting profession wants you to do this. They want you to keep track of all depreciation in a separate account. So instead of putting it directly as a reduction of this equipment account, we're going to make up another account called, let's finish my thought here. Originally, if you know anything about accounting, we're going to credit equipment and debit depreciation expense. But like I said, this part of it's not exactly right. So let's make up another account called accumulated depreciation equipment. And it says over here, this adjusting entry for depreciation expense was wrong. And it's why? Why is that? Well, the accounting profession says that you shouldn't put a reduction for depreciation directly to the account that you're depreciating. You should use a separate account called accumulated depreciation. And the basic reason for this is because of the cost principle. They only want you to touch this equipment account if you're going to remove the equipment and you remove all of it. Here it looks like somehow you sold off some of the equipment, but that's not what happened at all. What happened was you've depreciated it. And so here's my little drum roll for what I learned how to do with the PowerPoint. So here we go. I'm pressing the button. Let's see what happens. So like I said, this $4,000 does not need to be here. It needs to be here. So I will Well, let's try that again. Let me back that up. Let's try that one more time. Here we go. Hit the button. Aha. So it goes now from technically incorrect to down here to this separate account, $4,000. And so the entry in a journal form will look like this: debit to depreciation expense and a credit to accumulated depreciation. And then we're going to see, like we have on all the rest of these, what happens if you don't make this entry. Oh, and by the way, this account is called a contra account. That is, it's contra to the equipment account. It has just the opposite kind of balance, whereas this has a, you would increase this with debit, you would increase this with a credit. And after all the smoke clears, after all 5 years have gone by, you should have $20,000 in this account, which would equal the $20,000 balance you had in the original equipment account, which means it would be fully depreciated. So anyway, back to this. If you don't make this entry, what's going to be wrong with assets? And by the way, this is a contra asset, which means that if you don't make this entry, you're going to have the assets will be overstated by, in this case, $4,000. So if you don't make the entry, assets are overstated. Liabilities. There's no liability involved in this. There's an asset, contra asset, whatever, and an owner's equity slash expense account. So liabilities will be not affected. And then owner's equity. If you don't make this entry, then owner's equity, so you should have an expense here that lowers owner's equity, and you won't. So owner's equity will be overstated. Revenues, there's no revenue involved in this, and so therefore revenues would be not affected. Expenses would be understated. And if revenues are okay and expenses are understated, then net income will be overstated. Now let's look at a couple of little twists and turns from this kind of example to make sure you understand what's going on here. So let's change it up to the following. Let's suppose that you had the same exact entry, except this time you had a $2,000 salvage value. So let's look at that. We'll calculate depreciation by taking 20,000 minus 2,000, which is 18,000, divided by 5. And that means depreciation with the salvage value is going to be $3,600. So $3,600 goes there, and says we all know that it can't go directly to the equipment account, so it's got to come down to the accumulated depreciation account. And then let's look at a third twist, which is another twist, which is, you know, in the real world, you don't buy equipment all the time on January the 1st. You buy equipment throughout the year as you need it. So if we bought the equipment on October the 1st, how would we make this entry? Well, and still have a $2,000 salvage value. So this is a partial year depreciation, and it's also doing it with salvage value. So let's do the calculation now. So the calculation now would look like this. It would be 20,000 minus 2,000 divided by 5, which would be 18,000 divided by 5, and that's a full year depreciation. But we only have the months of October, November, and December, which is 3/12 or 1/4 of a year, which means that our depreciation would be $900, and we'd have depreciation $900, and it would go in the accumulated depreciation account. And I believe we're done. And that's adjusting entries in a nutshell.